Palantir reported earnings last week and the stock jumped by 20%. Shares are now up over 200% year to date. At the latest share price, Palantir has a market cap of $43 billion. With $3.3 billion of cash and no debt, the enterprise value is $39.5 billion. This was an impressive quarter from Palantir. Total revenue grew 17% year over year to $558 million, driven by a 37% increase in US commercial customers. So, while government revenue only grew by 10%, US commercial revenue grew by 33%. Even more impressive, this growth was achieved while operating expenses actually declined. Sales and marketing costs fell by 3.5% and G&A costs fell by 14%. Gross margin increased to 81% and adjusted free cash flow margin increased to 25%. So Palantir appears to be benefiting from acceptance of its new AI product, AIP, and its new bootcamp strategy is shortening the sales cycle, allowing for faster onboarding of new customers. Zooming out, Palantir has now produced $2.1 billion of revenue over the last 12 months, $150 million of net income, and $500 million of free cash flow. So, at 19 times revenue and 80 times free cash flow, the stock isn't cheap. In fact, 19 times revenue means it's the 7th most expensive stock with a market cap over $10 billion. But a good comparison here might be software business ServiceNow. Although ServiceNow has remained expensive by most metrics over the last 10 years, it's continued to be one of the best performing stocks. And that's because ServiceNow exhibits best-in-class growth, retention and margins. With gross margins of 80% and free cash flow margins approaching 25%, Palantir possesses similar qualities. However, there are some differences too. ServiceNow has maintained revenue growth over 30% for 9 of the last 10 years. Palantir's revenue growth this year should be only 16%, and it's slowed every year since 2020. Meanwhile, Palantir's net dollar retention rate of 107% puts it behind many software players. Let's assume Palantir grows revenue at 20% per year for the next 5 years and operates with a 30% free cash flow margin. That would put free cash flow at $1.6 billion in 5 years' time, and a 50 times multiple would put the valuation at $80 billion. That works out to an investment return of 13.3% per year. In other words, an investment in Palantir can work, but only if the company is able to accelerate top-line revenue growth and maintain one of the most expensive multiples in the market. Palantir could do that. The latest quarter shows strong momentum. There's a looming contract win with the NHS and a potential inclusion in the S&P 500. The valuation right now is extremely high, but it would be unwise to bet against Palantir with so many things moving in its favour. For that reason, I rate the stock a cautious buy, but these are my personal opinions, not financial advice, and I hold no position in Palantir stock. For more videos like this, check my new website 3minutebreakdowns.com. Thanks for watching.